Welcome to the Deep Dive. Today we're jumping right into Procter & Gamble's first quarter results for fiscal 26. These just dropped October 24.
Yep, hot off the press.
And our mission today is, well, pretty straightforward. Figure out how they beat earnings and why they're sticking to their guns on the full-year forecast, especially with everything going on.
Right. What's giving them that confidence? Let's dig in.
Okay, let's hit those headline numbers first. Q1 net sales came in at $22.4 billion. That's up 3% year over year.
Solid start on the top line.
And organic sales, the number we really watch, up 2%. But I guess the bigger story was core earnings per share, $1.99.
Yeah, $1.99. And expectations were what, $1.90?
Exactly, $1.96. So a pretty significant beat there. And on revenue, too, which was expected around $22.39 billion.
Well, it definitely caught some attention. But it's really important we unpack that EPS number a bit. There's the core EPS, and then there's the diluted EPS.
Right, because looking at the release, the diluted EPS number jumps out up 21% to $1.95, which sounds massive, almost too good to be true.
Well, yeah, it kind of is. That huge jump, the 21%, it's mostly because of what happened last year.
The base effect.
Exactly. P&G had some really big one-off restructuring charges back then. Things like liquidating operations in places like Argentina. Those charges pulled last year's number way down.
Making this year look artificially high by comparison.
Precisely. So that 21% spike, it's more accounting noise than anything. The real story, the operational strength this quarter, that's the $1.99 core EPS, up 3%. That's the number that tells us they executed well.
Okay, that makes sense. Focus on the core $1.99. So let's unpack that success. Organic sales were up 2%. How do they manage that in what the CEO called a challenging consumer environment?
Well, this is where their strategy really comes into focus. That 2% growth, it didn't come from selling more volume.
Oh, so where did it come from?
It was all price and mix. Pricing added 1%. And favorable mix, meaning people buying more premium products, added the other 1%.
Wait, let me get this straight. Organic volume was flat, 0% change.
0%. Globally, for the quarter, they sold basically the same amount of stuff as last year.
Wow. So they didn't move more units, they just got more money for the units they did move, either through higher prices or selling fancier versions.
That's the essence of it. The CEO called it strong execution of our integrated strategy, and that strategy right now is clearly leaning heavily on brand strength to justify pricing and encourage trade-up. They're extracting more value per item.
Okay, that's quite a strategy. If overall volume is flat, but organic sales are up, that growth must be coming from specific pockets. Can't be across the board. Where were the bright spots?
You're absolutely right. The performance was really uneven across the segments. The clear star this quarter was beauty.
Beauty, how much growth?
6% organic sales growth, really strong. That was driven by actual volume increases in hair care, think low single digits, plus that combination of innovation-led pricing and a really favorable mix shift towards premium stuff in skin and personal care.
Okay, so beauty's carrying a lot of weight. Anywhere else showing strength?
Grooming also did pretty well, up 3% organic. Again, similar story. Innovation driving pricing, and some decent volume growth, particularly in North America and Europe.
So the personal care, maybe more premium-focused segments, are doing the heavy lifting. What about the big core P&G staples? Fabric care, home care, diapers.
That's where things stalled. Fabric and home care reported 0% organic sales growth.
0 for Tide, Ariel, Downy, Fairy, all that. That's huge. Why?
Well, they did get some pricing gains, but those were completely wiped out by volume declines, especially, it seems, in Europe.
Okay, so volume weakness hitting the core cleaning business. What about the other big one? Baby, feminine, and family care.
Also 0% organic growth overall. It was a mixed bag within the segment, though. They saw a favorable mix in baby care, people trading up, but that was offset by volume drops in feminine care and also some spending on merchandising for family care, paper towels and toilet paper.
So it really looks like beauty and grooming are propping up the overall growth number, while the giant household staple segments are basically treading water, volume-wise.
That's a fair summary of the sales picture, yes. High-end pulling up the average, core staples facing volume pressure.
Which naturally brings us to costs and margins. This must put immense pressure on profitability. The reported gross margin was down 70 basis points. That sounds like trouble.
It does, and the pressure was real. If you look at the core gross margin, it was down 50 basis points, or 30 basis points if you strip out currency effects.
So what was driving that pressure down?
A few big things. Unfavorable mix actually hurt gross margin by 100 basis points overall, presumably because some of the lower margin staples still make up a huge chunk of sales. Then you had 70 basis points from product reinvestments and another 70 from higher costs, think tariffs and commodities.
Okay, add that up. That's, what, 240 basis points of headwinds hitting gross margin? That's significant. How did they even manage to keep the decline to just 50 or 70 basis points?
Productivity. This was the hero of the quarter on the cost side. Massive gross productivity savings, 140 basis points worth.
Wow, 140 basis points just from being more efficient.
Exactly. Sourcing, manufacturing, logistics. They squeezed out huge savings. That, plus the pricing they took, basically offset most of those headwinds you mentioned.
Okay, so productivity saved the day on gross margin, mostly. But the overall core operating margin was flat year over year, unchanged. How did that happen if gross margin still slipped a bit?
More productivity just further down the P&L. They found another 90 basis points in savings from their SG&A selling, general, and administrative costs.
So trimming overheads and operational costs.
Right. That SG&A efficiency essentially absorbed the slight dip in gross margin, leading to that flat core operating margin. They're running a really tight ship to protect the bottom line.
Okay, running lean, leaning on premiumization and pricing. Let's look ahead. The big news, maybe, is that they didn't change their full-year guidance. Still forecasting 0 to 4% organic sales growth for fiscal 26.
Correct. They maintained the outlook. Organic sales growth between 0 and plus 4%, and core EPS growth also in that same range, 0 to plus 4%.
Holding firm despite the flat volume this quarter and all the cost pressures we just talked about. That signals some confidence, but they must be baking in some serious headwinds for the rest of the year, right?
Oh, absolutely. They laid out the expected pressures pretty clearly. The total net headwind they're forecasting is about 0.19 cents per share for the full year.
19 cents per share. Where's that coming from mainly?
Well, there are a few components. They expect commodity costs to be a headwind of about $100 million after tax, but the really big number is tariffs. They're forecasting a $400 million after-tax hit from tariffs alone.
400 million just from tariffs.
Ah,
Yeah, that's substantial.
it is. And on top of that, they see about $250 million in after-tax financial headwinds, things like higher net interest costs and a slightly higher effective tax rate, which they expect to be around 20 to 21%.
Okay, so commodities, a massive tariff hit, and financial costs. That's a lot of pressure baked into that 0 to 4% growth guidance. Is anything helping offset that? Any tailwinds?
There is one significant one, thankfully for them, foreign exchange. They expect favorable currency movements to provide a tailwind of about $300 million after tax.
Okay. So the stronger dollar, perhaps, helping overseas earnings translate back better.
Could be part of it, or weaker currencies where they incur costs. Whatever the specific mix, that $300 million FX tailwind is crucial for offsetting a good chunk of those other cost pressures, makes the guidance seem more achievable.
Right. And finally, through all this pressure and strategic maneuvering, what about returning cash to shareholders? That's always a huge focus for P&G.
Still a massive priority. Cash flow was strong and Q1 adjusted free cash flow productivity was 102%. They expect that to normalize a bit, maybe 85 to 90% for the full year, which is still very healthy.
And the return numbers.
Still huge. They plan to pay out around $10 billion in dividends in fiscal 26. And on top of that, repurchase about $5 billion worth of shares. So yeah, a $15 billion total commitment to shareholders.
$15 billion going back to shareholders, even with flat volume and significant cost headwinds. That definitely underscores their confidence, or maybe the pressure they feel to maintain those returns.
It certainly requires sustained performance and continued execution of that productivity and pricing strategy.
So summing this up for you listening, P&G navigated Q1 by flexing its pricing muscle and successfully pushing more premium products, especially in beauty. This offset flat volume in core staples. And the secret sauce really was aggressive cost-cutting and productivity savings, which protected margins against some pretty major headwinds.
Yeah, that's the story of the quarter. But it leaves us with a really critical question looking forward, doesn't it? They've shown they can hit their numbers and reward shareholders through price, mix, and efficiency, even with zero volume growth. But how sustainable is that? The big challenge now, I think, is how does P&G pivot from relying purely on price and premiumization to actually reigniting broad-based organic volume growth, especially in those huge stagnant fabric and home care categories? Can they keep hitting these targets long-term without getting more people to buy more of their actual stuff? That feels like the next chapter we need to watch.